My name is Matthew Halpern. I'm a senior international tax manager at Eisner Advisory Services, and I specialize in cross-border transactions and multinational entity structures. Reporting on foreign operations for tax purposes is an important matter for many of my technology and life science clients. I always like to start a conversation with my clients by gathering a better understanding of their operations, their organizational structure, and customer locations. Oftentimes, I find my clients have already been doing business on a global scale. Perhaps their global operations are small, maybe a few online orders or shipments, but other times they are fully operational, already servicing customers with foreign offices and employees. Many of these foreign operations act as cheaper cost centers and back offices. Since the US taxes its citizens, residents, and entities on a global scale, the IRS requires an abundance of disclosure. Whether you have a subsidiary, office, investments, or simply a bank account located in a foreign country, there is some form of disclosure, and by no means are they simple. For instance, investing in a foreign partnership does not necessarily mean that entity is treated as such domestically. There are various default rules which create hybrid entities. A hybrid entity is one where the US tax classification is different from its local classification. This may create what are called controlled foreign corporations, or CFCs. CFCs are taxed differently from a US corporation. Oftentimes, there are income inclusions to the shareholders without the physical repatriation of cash. The tax effects vary depending on the type of shareholder, as well as the overall structure and operations of the organization. The US does allow a variety of elections that can be made to treat the foreign entities as partnerships or disregarded entities to better align the original intention of the taxpayer's structure of operations. Oftentimes, I see a US technology company opening a back office in India or some other European country, which has low costs when compared to the US. This foreign entity generally defaults to a corporation from a US tax perspective and automatically falls subject to the CFC tax regime. This can essentially tax profits of its back office, again in the US. Another situation occurs when a client has operations in a foreign jurisdiction, but without creating a legal entity. This often creates what's called a branch or permanent establishment. These operations are generally taxed by the local authorities and then combined from a tax perspective with the US operations. These examples can create an effect where the same income is taxed in multiple jurisdictions. Luckily, the US allows a foreign tax credit, which can offset some of this double taxation effect. However, there are many rules and restrictions regarding claiming the credit. Some of my life science clients, for example, want to take advantage of another country's favorable research and development credits, such as Australia. Instead of creating a legal entity in Australia, they may simply open up an R&D department and office. By hiring local employees to work out of this office, generally creates that branch or permanent establishment, which may be taxable as a separate entity from an Australian perspective. One of the last major types of reporting that I often see is when a foreign business moves into the US to tap our local markets. They may also be creating a branch or permanent establishment in the US by setting up a local office, hiring local salespeople, maintaining inventory, and conducting operations. The foreign entity itself may have to file a US tax return to disclose its US operations. These entities, along with their U.S. subsidiaries, also have to report any related party transactions. Oftentimes, when making a payment to a foreign person or company, even if related, can also create a withholding tax liability to the U.S. taxpayer. This mechanism is in place to ensure the IRS receives its share of U.S. taxes. The same can be incurred when receiving payments from foreign persons, and it's up to the U.S. taxpayer to ensure the withholding tax is minimized and utilized properly in the U.S. The penalties for not reporting many of these foreign items starts at $10,000 apiece, but they can be as high as $100,000. So the ultimate point is to ensure that you are adequately reporting any and all foreign operations. If you have more questions on this topic, we're here to help. Feel free to start a conversation with us.